Okay guys, let's go into this next trading example. We're going to be covering an ES short setup off the first 15-minute candle area. It was a weak outside day market environment, and we used the previous day high plus the previous close, and the break of the overnight low as our rationale for this particular trade. Let's go over the chart and see exactly what we looked for and what action we took. If you need help again with this particular section, review parts 2 and 4 of the derivatives day trader course. Let's get into it. Okay, so taking a look at this screenshot, we have the ES on a 15-minute, 60-minute, and daily chart. We always use our multiple time frame analysis when we're trading. It gives us different views of the market and what's going on, and helps us identify the opportunities that we're looking for. As you can see in this particular example, we have our price matrix as well. We're actually up pretty nicely on this trade. It worked out pretty well. The risk to reward ratio was over 3 to 1, and let's talk exactly through what we looked for. In this setup, we were looking for price to get back up to the previous day close / open area to short. Sellers came in and pushed prices down from that area before. In this blue area right here, you can see the market dropped off out of this particular area right above 2400, big round number. Price had based out after the initial drop and never got back up to our initial entry until it was time to execute our short. So prices dropped, based, and rallied back up. The red line is the previous close. Green line is going to be the open. The size of the drop, the size of the drop is something that we pay attention to as well. This move away from this level showed us that there were sellers up in this area above 2400, and that we could potentially see further weakness. Now going back to the weak market, the outside day market, let's go to the daily chart. You can see that we have our high and our low designated by the blue lines of the previous day, and the red and the green, previous close, and the open. Now these numbers, the red and the green in this particular picture were off a little bit. The close should be down here and the open should be right above it. So we just needed to move these down a little bit right in there. But we can't go back and change the screenshot, so I'm just going to explain that to you right here. But basically, we had a weak market environment with an outside day. And again, in that type of trading, you want to look for some shorting opportunities. That's when you have some higher probabilities to short. And just as the opposite, if you have a strong outside day, you'd want to be looking for long opportunities, pullbacks into areas that you want to buy. In this case, it's flipped. We're looking for rallies back up to prices that we can short at, and that's exactly what we got. So again, the green line is the open, the red line is the previous close, purple line is the overnight. And so once prices drop through the overnight level, drop through previous close and open, we were waiting for the market to get back up to this area for a chance to short. Not only did we see these things happening real time, knowing that we were in a weak market environment with an outside day, meaning an outside day you can see an extended move in one direction or the other, versus an inside day where trading is going to be more range bound and choppy, we expected the market to move in a strong fashion out of this area if we got an opportunity to retest. You can see on the 60-minute up in here, the market dropped, based, and then rallied back up. I know it's a little bit hard to see that right in here, but basically the opportunity came right in there on a retest off this big drop. So we have it on a 60-minute, and we have it off a 15-minute with the validation of the outside day weak market environment off the daily. So the higher time frame, the smaller time frames are all showing confluence, giving us conviction in the trade. So we simply waited for price to rally back up, found an area right above 2400, right above the previous close, right above the open, and an area where the market dropped out in a strong fashion. We had a drop, pause, and then another drop, creating the area that we were looking at. This is our AOI, the area of influence, area of interest, excuse me. So once the opportunity came about, and that takes price rallying back up to this area, we went short. We went short right above 2400, and you can see at that time when we took the screenshot, we were up about 725 bucks on one contract. We were up about 14 points here on the ES, $50 a point, and so that gives you around 725 bucks. Not too long after this, we got out. We saw that there was some buying in here. You can see that the market stopped going down, retested, stopped going down, and shot up. So this was our profit target area down in here, denoted by the green box. And that's what we were looking for. So this example is very straightforward and simple. And these are the type of trades, again, that we're looking for each and every day. They don't happen each and every day, but knowing the bigger picture, knowing your market environment is going to tell you which type of trades to look for. Which side of the market do you want to be on? There's no doubt that you could potentially buy down here and take it all the way back up here and get out and then wait for it to go down and then get back in. It's easier to see it in hindsight. When it's real time, you want to have things that you can rely on and go back to lean against, and have a repetitive process, if you will. You want to have a strict criteria in terms of what you're looking for, why you're looking for it, and really knowing what to look for in a given situation. So you have the weak market environment, you have multiple time frame confluence, and not to mention this was basically the first 15-minute high right in here. The market opened right in here. The first 15 minutes was right in here. This was a retest of the low of the first 15 minutes worth of trading. And we've talked about that quite a bit in our trading, in our examples, in our, with our members, the importance of the first 5 minutes, 15 minutes, even the first 30 minutes, and even hour of trading. And we lean on the first 5 and 15 quite a bit to find areas like this for trade setups. First 5 and 15 minutes, for whatever reason, tend to produce moves away from those levels, and that's something that we look for in our trading. And this happened to coincide with a previous close, an open, a weak market environment, and confluence on multiple time frames. Not to mention that the profit potential, all this white space in here, was there to set up a nice risk to reward ratio. So hopefully this example was helpful for you guys, just giving you a little insight and idea of what we look for in the markets and how we make money in the markets each and every day, trading futures specifically. If you need any more help with this, if you need to go back and review, like I said at the beginning of this example, review sections 2 and 4 of the Derivatives Day Trader course. Let's move to the next one.